There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome, Auvorians, to an expedited edition of the 21st of January, Saturday software strategy session. My name is Steve Federal. I try to bring the content that is relevant, that will help you with risk management, allocations, trade location. Focus much on that. But I will tell you, I'm actually having a meeting coming up with Bill and Matt, the two owners of Auvoria. And we're going to be talking, I guess they have a new algo coming on board, which is cool. It's also been some pretty decent developments in a whole bunch of other arenas, so stay tuned on that. Wanted to circle back around with my two favorite guys. It's a good group to work with. So let's get into the weekend. So let me just make the screen a little bit bigger here. It seems like I failed to do that. I have failed. All right. Between the Hedges is hedgefundmanager.blogspot.com. I try and go through this because it's an aggregator of news. So like if you want to see the leading source in Bloomberg or Fox or any of the mainstream zero hedge, these guys are always on the edge of craziness. Some funny stuff. I thought this Taylor Swift song that ChatGPT wrote was actually pretty good. Big tech layoffs, as many have heard. I was just go through this, just pick out some pieces, but most of what I focus on, honestly, is really just trying to understand, what's in the head of Jerome Powell and the 12 regional Fed governors, in addition to other central bankers. So last week was the ultimate elitist dog and pony show in Davos, Switzerland. Look, it's a great place. I'm not knocking on the region. It's one of the best in the world, especially for skiing. But it is just a dog and a pony show. And, hey, my hat's off to the few that don't want to hobnob with the global elitists group, right? So I've often joked that this is where the Bilderberg conference takes place. And, they have other break-off meetings that the Illuminati gets together and sort of figures out what's going to happen in the world. Look, it's all speculation. It's conjecture, right? It's conspiracy theories. It's probably all BS. But if, in fact, something like that does exist, you want to be cognizant of what the plan is, right? What are they going to do to the dollar if, in fact, this group exists? How are supply side, most of this stuff's being shored up. But in terms of supply chain issues, which has affected inflation, obviously. So, there's been all different kinds of schools of thought. I always say that I'm an aggregator of the best, right? Because I am not as good, nor do I put as much time into this as these guys do. So as an aggregator, it is my job essentially to look through all the news, as it should be all of yours that have this level of interest, and see what's going to occur in terms of potential for the market, right? It's almost like you're trying to read the tea leaves across these different news sources to see what's going on. So obviously we got global conflict. We have global interest rates. There's a lot of stuff going on with all of this. By the way, the site has, in terms of the all links, it's actually really good. So in terms of global news, they cover everything in links. So if you want to see videos on what's going on, you can do the same thing. Anything that has to do with watchdogs, financial news, these are all linked to here. It's actually a great resource. The problem is that from a risk standpoint, even some of the best traders out there, and not the most newsworthy people like myself, I kind of get caught up in the news sometimes, right? So, I've pre-programmed my subconscious to always have that little person sitting on the right shoulder and the little person sitting on the left shoulder, and they're basically telling me usually opposite views, right? But I know these two exist. I know these two have a tendency to drag my focus into other areas, so that once I'm heading down a path, right, I can recognize it usually pretty fast. So I would encourage you guys to sort of have whatever is your little signal for things going awry. You can use it as your inner monkey. You can control you can't control any of this stuff. And there's a fair amount of ambiguity that is involved with all of this. If one is not okay with that, essentially, I have yet to find the tool that tells me when the bell is ringing at the top and the bottom. I found some stuff that's come pretty close. I feel I've had a lot of that overlaid on my charts. But at the end of the day, you just don't know. So you can go in with the most educated guess that you can formulate for your thesis and go with that, right? So I've just summarized in less than probably 5 minutes the entire realm of investing. But core to that, in terms of components, which I've talked exhaustively about the last 2 years, is the importance of position sizing, right? So I talked a fair amount about that last Saturday. If you want to get into that, I'm trying to cover some of these topics right up front through the news. That way, for those that don't want to really stick around and go through my long diatribe of charts, they could sort of cut this broadcast off. I have no offense against that. So let's take a look at the next week before we get to the charts. Get ahead of myself here. Holidays, Sunday, Monday for the Chinese folks, probably deserve it. At least after the government's been beating on their heads. The key next week, if you're down in Aussie land, CPI. Bank of China, Policy Statement Bank holidays again next week down in Aussie land, as well as the core PCI next Friday. Now, this is not something that in the past, before the last year, was followed by the common retail trader, and some did. But now this is much more viewed because Jerome Powell's flat out told us that this is an important indicator for him, right? So you're looking to see, the change in price of goods and services purchased by consumers. This is X, food and energy, right? So a lot of times you want to strip out food and energy and get sort of that core PCE, okay? So this differs from core CPI that only measures goods and services targeted towards and consumed by individuals. So I like the thing I've always loved about Forex Factory is it really is it's a common breakdown of what it is, but it carries weight. So this will be important to see. Could certainly control markets, which have been, at least on the S&P, we've been flagging for on the daily charts and the weekly charts, and we're going to be breaking one way or the other at some point. My bet's down, but there's enough pent-up potential that we could break up real quick, blast out all of the Q, if you will, above 4,000 in the S&P, and then just take it back down. That, ladies and gentlemen, is my thesis for the S&P. Whenever you're looking at a chart for anything, and this is something you want to do when typically you can have some sort of aggregated volume, right? If you're going to be using the blue profile with the blue lines that I have in the red point of control, which is the center line of aggregated volume on execution, I should say, this is where all the prices settled out at in terms of the volume that was bought. You always want to just look at having that data, unless you spent a lot of time in some of the upper range or lower range and maybe trading in. So right now I actually have too much data on the screen for being a short-term trader, right? But from the perspective of always knowing where areas are that are, like an open or an out there point of control that may be in a lower range, or, obviously value area highs and lows in this particular case. Notice it's been almost like a center line through where we've been bouncing. Now, I don't really think this is the right data on the screen. I think I got too much. We go back to just the data for this particular range, right? You can even argue I can get rid of everything below that. I'd say you want to see this green candle right here. I want to probably bring it out almost to right there. It's too much. So, you can actually set this by date, but I just don't like screwing around with that. Point is, for its current level, this value area low is totally held the bottom of this range. Now we're hovering around the POC. So this is a market that is trending or trading sideways. I call it building a balance area. Some people call it building a profile to the right. Regardless of what you call it, the key is that the market's at an indecisive possible crossroads position, right? This chart pattern of how it's playing out can move across almost any class. If this was a US dollar or a euro-based chart or any of the majors that I cover, really the same thing's building. We've got a lot of confluence where we're currently at. We know that inflation may be coming down. We know that the Fed may be stopping. At least that's the current thought. Probably 50% of Wall Street and global traders, and then the other 50 think the Fed's going to go another percentage point. But I can tell you, if some of these numbers come in hot at any point over the next quarter, Fed's going up. And I don't really think that's priced into anything at this point. So that could cause an absolute landslide of money moving back into the dollar. So the reason I explain all this is that I always want you guys, when you're looking at a chart, to look for what's called a region of max pain, meaning that if you can successfully envision an area where nobody's thinking about, right, or at least collectively nobody's thinking about, that we could go to, then you have a likely shot that that can happen, right? So we're somewhere right up in this area here, right? I think more people are betting on us going back down to visit the bottom. So as I move into the Q1, and unfortunately, the little time I've spent with this, because we're actually meeting with some pretty big people in DC, which is cool. Trying to forge through our future with the U.S. government in terms of financial planning with First Down. I haven't paid attention to the markets. Haven't done really much trading in the last week. But as I sort of dust off the cobwebs this morning, which I like to do live with you guys instead of having this all prepped out, that's how you can sort of see how I attack this, depending on how much time I spent the previous week. Maybe I'll give you some tips and tricks on sort of the best way to analyze this stuff. But as I come in, I'm always thinking about, what if I'm wrong, right? What if I am incorrect in my forecasts? Something that I give almost 100% of credit to Ken Fisher on when he taught me to do all this a long time ago. Always be thinking, how am I wrong? And if in fact I am wrong, what is my plan? And most people can't answer this question. I can't tell you how many times I've come across somebody that is what's called a self-manager. Let's say they're managing $1 million. It's sitting at whatever discount brokerage firm, and it's allocated into, whatever investments. And, they're living off the heydays of 2009 until the beginning of 22, right? When everything they did just went straight up, and they were experts. And then I'll ask them what's their strategy is. They'll be like, well, I'm diversified in these stocks, or I'm like, no, that's an allocation. What's your strategy going forward? And they're like, well, I just, they don't really have an answer. And the smart ones will say, well, I don't really have a strategy, right? And then my next question is, well, don't you think that's a problem? You got a couple $1,000,000 you can manage. You made a whole bunch of money on it. And you don't really have a strategy other than diversification. It's just not a strategy, right? It's an allocation. And I tell you guys this because I don't want you to be these superheroes, okay? You have an inordinate amount of people out there that think that just because they got a few $1,000,000 are God's gift to trading and investing. They very rarely are. Because when I ask them, did you think the market could drop another 25%? Unequivocally, the answer is no. Why? Because they've been bullish in equities for most of the last decade, and they never really fought through 2009. They haven't been through 2002 when the market got cut 40 to 60%, depending on the type of stock, right? So, look, I get it. Sometimes this isn't always a Forex-based weekly session, but I think the problem with investing is that there are way too many people that think they should just be all in one thing. Okay, if I handed anybody in this audience a couple $1,000,000, my question is, what would you do with it? Right? Maybe you'd flip a couple of houses and you'd fix stuff, right? Maybe you'd, but never, at least in my experience, the people that have been following this, would somebody come on flat out and say, well, I just put the whole thing in the Forex market? You wouldn't. So you would diversify across different kinds of asset classes, right? Maybe you'd buy some bonds, which have been going down a lot, right? There's inflation protected ones, got a better yield. Maybe you put some money in equities, ETFs, or stock-based funds. Maybe you'd hire a money manager like us, right? But you always want to be thinking about, how would I act as if I had X, right? Probably one of the more powerful things in neurolinguistic programming that you can come across is to envision yourself doing something. Or I've used that Michael Jordan when he played for NC State example, and it was very, very powerful. As many of you know, I graduated Xavier University with a finance degree over 20 years ago. And I'm a huge Xavier Musketeers basketball fan, Division I. They're absolutely killing it this year, right? But one thing I just love about Soleil Boom, who is one of our lead scorers, this guy's consistency is just absolutely off the charts at the line. I mean, his ability to make free throws are in the low 90%. That is like almost unheard of. Yes, it's existed, but his ability to focus at the line, I've got to believe, is a huge part of him just picturing himself always making a shot, right? So most of what I've taught to students over the years, obviously have the confidence someone like he does, or any top sports athlete, but their ability to focus and put all of the noise aside. And let me tell you, it is absolute pandemonium on a basketball court. So if you're able to put all of that aside, just focus on the most important thing, in this case, getting it in the hoop or having your trade win, then everything else just becomes fairy dust to you. It doesn't phase you. So, but the analysis to get to that point, right, is the tough part. The emotions that come with it can be incredibly swaying. And I say that because and I have tons of the stuff on my website if you ever want to check any of it out. Site's fxestrader.com. Go to the glossary, and you can see all this. So it goes through trader types. It goes through all that stuff. And most people I find are either a gunslinger or they're a revenge trader, right? These are two particularly destructive paths to get out. One, you think you're God, and two, you're just trying to get back a huge chunk you lost, right? Very rarely, like being at a casino forever, very rarely is the house in your favor. Ultra rare. You're going to give your money back to the market. It's just a matter of time. It's like a casino. I'm not a gambler. A lot of people say, "Hey, Steve, you used to live near all these casinos in California." Yeah, I've been in Pechanga twice. When I go to Vegas, it's usually for other stuff, whether it be golfing or some sort of event. It's not for me to sit in front of it. The only thing I did successfully was Texas Hold'em poker. It was a while ago. But the important thing is, and that's because I was playing against other players, usually a bunch of degenerate drunks that are easy to take their money from at 1 a.m. in the morning. But outside of that, I don't believe in statistically being a sort of bird on the perch waiting to be shot off by whatever market, right? I want to be that nimble hawk flying around trying to figure out what's going on. In the case of the U.S., a very famous bald eagle. So, my tangentialness continues this weekend. Let's take a look at some charts. That's enough of equities. Let's get into. By the way, guys, I actually came across a client of who unnamed, but this guy put a couple $100,000 in NVIDIA in 13. Yeah, it's 2013. Even though this stock's been cut in half, it's one of the biggest capital gains I've ever seen in a client account. I mean, it was a monster. It was in the millions. It's actually done really well in this stock, even though it's been basically cut in half. So, as the saying goes, there can be great things that come out of long-term investing if you have the fortitude to make it through it. DXY. So as I've been talking about the surprising continued decline in carnage in the dollar, which is the absolute opposite of the last quarter, right? Continue, I should say, was the absolute opposite of the third quarter. The fourth quarter was the complete inverse correlation movement. It's going down. We're on a weekly chart here, so let me just drop back to daily. What do we see that has arisen on our chart? I would say just back to the scene of the crime, just off the first cuff of view here. So this 102 area is offering some support. We spent enough time here, it would be my assumption. And obviously, these inflation numbers next week can completely change that thesis. But for now, we've had last week we had a strong hammer reversal, but we had a doji here, which is indecision. A couple of them we're holding at some support. So if we spend a couple more days there, it's possible we could go back up and visit to the high of the range. I would say that's probably more likely. But do keep in mind is if one says something like, yeah, it's a great forecast. Well, how could I be wrong? I could be wrong in that the obvious. There hasn't been a move back up this high since we completely rolled over, right? For those not knowing, this was your first cue was a slingshot right here that we're probably going to break this point. Right? So those betting short on this would have said, well, where's the bottom of this upper range? And it's right here at just under 108. Notice we cracked through that. There's another slingshot. These are attempts to continue to get back on shorts that you may have already successfully closed out, or are keeping a couple of runners on and you re-add back to the trade. So, the scene of the crime essentially was here, right? You always, in a correctly formed downside pattern, will have a visit back to the scene of the crime, as I like to say. And those are always the lowest risk trades you can from a short perspective, right? So you had first break lower, totally held. You had the bulls come in and push it. Notice you coming back up here. The smart people are beginning to say, well, here's our slingshot setting up for another downside run. If this doesn't hold watch how fast we move back down to the downside and then ultimately break, which was some of the biggest support at this region. So the theory would be like the following. I don't have, obviously a market profile overlaid on this because it's just the DXY, but just for the purposes of understanding chart patterns and how they play out, if this did not have sort of the gusto to get below this and continue to move lower, which is my suspicion, it's going to probably move back to this area pretty quick. If this does not hold, this will be the ultimate area of stop, I would think, because it was back to the scene of the crime. Now, this late in the trade, if we ripped right back up here, you could short it again, but you're really late to the game. So, let the extreme outs play, because I can guarantee you there is a pocket of stops up in this area for at least the long-termer folks, right? So max pain, I would think, is somewhere in this zone if we got back up to the area. Depending upon what played out, and I'd be looking at a lot of the other majors charts for signals, obviously from a volume perspective in the aggregate, but I would imagine this holds. But I could tell you this is probably where the biggest max pain trade of this is, because you have overwhelming consensus. The dollar's done going up, right? And they say just ride the trend down until it changes, right? So far, there's been successful trades since the top. Remember, I could be wrong. So let's take a look at the euro US dollar here. So as we're looking at it, basically the opposite, to a degree, of what we were just looking at. Here's the bottom. We were hovering down around parity, slightly below. Notice how parity is now the value area low. This is pretty interesting. Even if I bring more data in, it's not changing this chart much, if you've noticed. So POC, right around 1.06 on this. 0.550 area. Big. This is where most of the trade took place over this February. It's basically looking back a year. From a market profile perspective, this carries more weight with me because it is a location, if you will. It's almost like putting a pin on something. Where did all the trade take place, Steve? Well, right here. POC, point of control. This could be a zone, doesn't have to be a specific price. Value area high at the blue, the top, 110.60 area, and at the bottom, parity. Let's take a look at the dollar. Jumbled around all my currencies. There we go. Now this one is, quick peek at the weekly. So this was Armageddon. Remember they made that crazy policy change, and I didn't remember the name of the prime minister, the female that resigned. I don't even remember her name. Was it Meg or something like that? I think it was probably Meghan Markle, right? Get all mixed up. Notice how we're just being magnetized, if you're going to use that term, right back to that POC number. This is a long-term chart, so we're looking at many years. So this is where most of the trade has been executed at, this 1.330 area, 1.3130. What's showing up? 1.3130. At some point, see if I keep shrinking each candle size, thus viewing more on the screen, bringing in more and more volume data, right? So we're running past now 2 years. And I'll just walk this slowly close so I can see what's going on. We're obviously looking at a ton of data right here, right? Look where that POCs has jumped to from a daily chart perspective. So this is the area it sort of wants to hang around. Does that make sense? And it also just happens to cap the center point of the highs and lows of this entire range. But notice still way up here, value area highs up there. So the pure market profilists will say, well, this is where we're headed. But if, obviously if I expand the data out, we can see less data in the aggregate, and that's going to change the looks of these lines. So I'll just walk this through. You see me doing this, less and less data, right? I want to see how these profiles are jumping around, and I use that to sort of formulate either a bad thesis and back it up, or sometime I'd want to change my thoughts on what can happen, right? This is almost like envisioning how this would play out. As you bring less and less data and you bring down more to a fine tuner. So for those that scalp, which is nothing more than just lots of rapid fire trades, and typically all you're doing is making your brokerage firm money, not you. But there are scalpers out there that scalp with big size in futures and forex markets. They're pretty successful at it. So not knocking the process, is just you really, really need to just drill down into a microcosm of what I show half the time in order to see what's going on at the fine tuner of the volume, print, or footprint level of executions on a price ladder. And that's where you can begin to see, how changes are made. It's also a great way to see where pockets of fools are hanging out, because there'll be just a ton up the dome on the bid, or maybe there'll be a whole bunch of stuff up there on the offer, and there'll be a bunch on the left side down there on the bid, and you can just kind of see what everybody's playing it out. The problem with that is, a lot of that is just it's flashery, as I call it, because they're just trying to load up the dome to confuse you. So that's why I prefer a market profile chart like what you see. You can drill this all the way down inside a minute type chart. The beauty of the execution volume in the aggregate is that's actually what institutional retail traders did, right? It's what they did, where they bought. I think there's a lot more insight that can be provided in where they bought than all these fairy dust, profiles up there, right? Maybe I shouldn't use that word. It gets confusing. There's a lot of, and this is all like deep level 2 stuff. They're flashing orders. It's almost like they're fishing the screen for you. And I don't fall for it. And I don't pay as much attention to it. I may use it a little bit if I'm looking for a better execution on a trade. Like if I got some, maybe I took a whole bunch of profits, or maybe I'm getting my ass handed to me in a loss and I'm just looking to get out. You're going to use the dome and all of the volume of the orders out there for sale doesn't mean it's going to execute, right? A lot of them just get taken off the screen. So, in seconds, your whole thesis can be falling apart, right? So, but really the key is just understanding that what matters to me most is the real world, meaning what was done, right? Where were all the houses bought in your neighborhood collectively? What price range, right? That's something there's meat on that bone that you can use for pricing your house, right? Or pricing whatever you're selling. All this is doing in market profile terms is putting it on a profile and setting it from the perspective of a chart. You want to focus on that 70% range, the value area high, 70% of the entire range that you see. Remember, there's shaded light blue above and below these always. But the value area is where typically trade wants to gravitate towards. All right. I think I've drawn probably lots of folks that are confused. So if that's the case, I apologize. But honestly, anybody that's going to be a trader in this area, I think you should take a market profile course. I really do. You can start with reading Peter Stedelmeyer's book. There's a lot of other individual Stedelmeyer's taught. Many of them are getting pretty old, but stuff does really holds true. It doesn't really change. Keep in mind, I just show you guys the volume-based market profiling. I don't show you the time-based, right? Because it's not on this type of system. So, Steve, we just learned the volume. Now you're bringing in time-based profiling. Yep, that's as not as important as the volume, right? But it still carries a certain amount of weight. So, all right, cool. You guys will see this gold's really been heating up. A lot of people don't do gold trades, but I don't show this a lot because I want you guys to turn into crazy gold bugs. This planet's littered with them. No offense if you are that person, but I can tell you there are other places out there to make money on your money, and the world's not going to fall apart tomorrow, in which case the raping and pillaging of the countryside is going to take place. But I do understand if you are that type. I would just say look beyond gold. There's plenty of other asset classes to make money in. Even if you don't trust them, you can still fish around in their smolderingness, right? Like if equities get clobbered another 20%, historically about it, last 100 years. You may not like it, but you can certainly sift through the smolders, or the cinders or whatever, and find some quality stuff to invest in. My name is Steve Federal. Hope you guys had a great session. Hope you learned lots. Feel free to hit me up on Telegram if you got any questions. You can also send me an email. It's sfederal@AuvoriaPrime.com. Wish everybody a great weekend. Cheers.